Okay, let's talk about debt now. Now, the characteristics of debt are commonly known and understood. A liability pays interest, taxes. The interest payment is tax deductible, and a loan, a debt, does not represent ownership in the firm. That's straightforward. Let's move on to other types of securities. Keep in mind the distinction between technically between bonds and debentures. Bonds being secured by assets, and debentures are unsecured in nature. And interesting categories of other securities that are instruments that are available in the capital markets. Convertible debt. This is a kind of like a bond. A convertible bond is one where the investor initially is lending to the company, takes the form of debt, but has the possibility to convert that debt into equity to be able to buy shares, surrender the bonds, and get shares at some predefined conversion feature. So this is one of those cases where a debt holder can be converted into a shareholder in the company. Subordinated loans refers to a ranking of a loan. In other words, a subordinated loan cannot be repaid until the loans which are ranking superior or senior to it are paid. Let's just take a simple example of that. If a parent company, for example, wants to make available finance to a subsidiary, it can do so by increasing the subsidiary's share of capital. But if the parent company doesn't want to commit more to have equity exposure to the subsidiary, it can lend to the subsidiary. This way it gets a interest payment and also can provide for a repayment date on the loan. In the meantime, then, if a bank were to lend also to the subsidiary, the bank may set as its conditions that the bank should be repaid before the parent company loan to the subsidiary is repaid. That would be an example of subordination. Now, warrant is another type of instrument, which is an option, essentially. It gives the buyer or the holder of the warrant the possibility to buy shares in a company at a preset price. So it's typical option type of conditions. These instruments can be traded in the secondary market, so they have a market price. Then there's something called deep discount bonds, or they may have, which have very low coupon, or in fact a zero coupon, and this could be done for tax purposes. In other words, an investor buys the bond and receives no coupon payments on the bond. He receives only a larger amount, face value of the bond, at the maturity of the bond. This could be interesting to certain kinds of investors where the interest on bonds may be taxed at a different rate from the capital gains tax. So this is more tax technical type of reasons why this instrument is traded. Bear in mind that many of these instruments exist because there is investor preference for them. So the market is really determining whether or not a company can structure a certain investment and successfully sell it into the market. So companies have to be innovative. They have to talk to their lawyers, their accountants, to understand what the investors want to have and structure instruments which are quite innovative and certainly not standardized. Let's take another example of such an instrument, a so-called high yield, or more popularly known as a junk bond. These are speculative debt instruments. There are, in fact, instruments that may have no investment grade. They're considered speculative, but there is a class of investor out there in the market that likes to buy these sorts of bonds because they like to take the gamble that if in a portfolio of junk bonds one company does recover sufficiently that it's the value of its securities go racing up spectacularly, then of course an investor can make a lot of money on this kind of investment. Also, think about it this way from a diversification point of view. If you are a hedge fund with lots of money in the billions of dollars to invest, you might say, well, 2% of our overall portfolio we can invest in such high yield bonds. Why not? If they are a complete write-off. The hedge fund loses only 2%. However, if they pay out handsomely because there's a favorable an investment works out favorably, then of course this 2% can become much larger in terms of its value. Right, let's move on to interest rates now. We should be aware of the fact that in the market there are interest rates of a fixed rate nature, so companies that are borrowing for 5 years at fixed rate are expecting possibly interest rates could go up, and they want to lock into a fixed rate. If companies feel that they need medium-term finance but they think that interest rates could go down, then they would probably elect to raise finance on a floating rate basis. Now, choosing the right capital structure, this goes to the heart of corporate finance, and we want to pay some attention now to what some of the considerations are when a company is looking at how to structure the liability side of its balance sheet. Now, one could look at the debt equity question in the following way. If one has a small amount of shareholder money invested in a business and uses a great amount of debt, then when the company makes a lot of profits, the debt interest has to be paid, but most of the profits then that's left over can be distributed to the shareholders. So it's good for a company to want to use as much debt as possible. However, too much debt, of course, can put the company into some trouble. So for this reason, a company has to examine what the best balance is between debt and equity. Of course, the industry that the company operates in has an influence on what the proper capital structure should be. Think about revenue volatility. If the revenues are moving up and down drastically, then possibly a company will be more conservative and use less debt. Operating leverage, that's got to do with cost structure, the relationship between fixed costs and variable costs. Again, a company will want to be a little bit cautious about how much debt it uses if it has high fixed costs, because if it has a decline in business, it still has to pay those fixed costs, even if it's not generating very good revenues. Okay, so it's like an art, and there's a trade-off involved, and so one needs to keep these sorts of issues in mind. Leasing, of course, is another very favorable way of, or interesting way for companies to finance themselves. It's usually connected, of course, to an asset for which lease finance is obtained. Operating leases are usually in the form of short-term rental contracts. By definition, they can be cancelable during the lease period, whereas finance leases or capital leases are basically, in their substance, effectively like taking a bank loan. So one should be familiar with what the key criteria are. In general terms, the lease term covers most of the asset's economic useful life. The lessee takes responsibility for servicing the asset, that's the person using the equipment, and that a cancellation clause would hold the lessor, that the owner of the equipment would hold them harmless for any losses that they would incur. And there may be an option to buy the asset as well. So effectively, a finance lease is a situation where the lessee effectively would, as an alternative to the lease, would have bought the asset because they intend to operate it on a permanent basis. Okay, also to be reviewed is the attractiveness of leasing transactions. This is something that has to be subjected to a financial analysis to see what the cash flow on a discounted basis will what advantages it will provide a company which uses leasing as a kind of finance. So just to summarize, there may be cash flow considerations for using leases. There's a cost reason. The company has to make a comparison of the costs of leasing versus a straight bank loan, and of course there are tax considerations that come into the picture as well. Sale and leaseback is an interesting type of transaction where a company sells an asset. Think about a bank, for example, that may own its headquarters, and it doesn't particularly need to own its headquarters, so it may sell its headquarters, get a lot of cash, and then rent those headquarters. So in other words, remain as a tenant in the building which it previously owned, but through the sale, they're able to put the cash they derive into further loans, so they can actually pursue their business and have more resources. So it's kind of a solution which works for many companies. And finally, there are hire purchase and installment plans that can be put together in connection with the acquisition of an asset. I leave the candidate to read about public-private partnerships, what they are all about. And finally, when a company is considering how to finance new projects, typically they will do so by choosing to use internal funds first, because that's most readily available and there are no transaction costs connected to it. And then secondly, the company will borrow before it will go and issue equity in the market. Main reason being that equity is the most expensive to do, and therefore what we call the pecking order, as you can see here, is the natural kind of steps that a company considers in determining what sources of finance it has available to itself.